how to exploit Bitcoin for profit. There's a multi-million-dollar industry in predicting crypto prices.
Crypto investment and trading are like a game in which winning or losing is determined based on market factors. These factors sometimes have to be determined quickly, in a matter of minutes, even in a few seconds.
We are seeing that Bitcoin is retesting the $60,000 level once again.
How do you see things changing in terms of digital assets in the coming years?
We're really seeing some interesting action going on, but what's really changing is the growing role of institutional investors in this new asset class.
There are tools that we can use to analyze patterns and investor behavior over time. And while these models are never perfect, we can still use these tools as a strategic piece of our investing strategy. Understanding the basics here will literally save you money in the future, so you better listen up. When it comes to price predictions, we need to start with how Bitcoin is valued. People like to compare Bitcoin to gold as a store of value because Bitcoin's limited supply of coins and the difficulty to produce more of it through mining. Beyond its relative scarcity, though, there are several other variables that come into play, like digital payments becoming more popular, the security of the Bitcoin network, or the effect of news events. What you'll see many professional traders do is look for opportunities to profit on trades through different degrees of price analysis. Typically, this is done by looking at some historical data point and attempting to predict the future. Today, I'm going to talk about 4 ways that you can make measured, grounded assessments of Bitcoin and other cryptos' value and then use those to profit in the future. And speaking of profit, a quick portfolio update. I post all of my buy and sell alerts on Patreon. Today, we're looking at the last 30 days performance. In the last 30 days, my crypto portfolio is up just shy of 38%, more than $50,000. If you'd like to subscribe to my buy alerts, I have opened up 25 additional spots for the Patreon, linked in the description below. Make sure you nab one of those before they sell out yet again. Now let's cover the advantages and, of course, the limitations to each of these prediction methods in crypto. The first method is watching exchange inflows. The main theory, which has proven to be reliable to an extent, is that you can read investor sentiment by the amount of Bitcoin flowing into exchanges. This is due to the correlation between inflows and the pressure to sell. This technique was brought about by Chainalysis, a New York-based crypto research company. And at the time, it quickly became a broadly accepted tool for gauging volatility in the crypto market. Many exchanges now have indicators of buy or sell pressure based on the amount of a cryptocurrency flowing into their system. The assumption is that when there's an oversupply at exchanges and investor demand can't meet that supply, the price, of course, drops. One example of this theory in action came right before the Bitcoin price drop as a result of COVID-19 news in March of 2020. There were about 1.1 million Bitcoins entering exchanges during that period, over 700,000 more than the average at the time for 2020. So an educated trader could have seen this anomaly in trading activity and made the call to sell before the price dropped further. This technique is used by institutional investors and professional traders for short-term strategies because predicting volatility helps in finding good entry and exit points on your positions. Short-term trades are worth it for investment firms, particularly because of the amount of capital that they have to work with. Small gains that can sometimes happen within just a couple minutes or even seconds can sometimes amount to thousands of dollars in profits, especially if your starting capital is in the millions. But of course, this isn't a sure bet, even for the big players. It's more of an art. Crypto is inherently volatile, and for retail investors, it's risky and sometimes very costly to try and time the market. Still, watching crypto exchange inflows is a good way to stay informed about the price movements in cryptos. And following the trading activity of institutions to find cheaper entry points can be a good plan as well. Now, the next prediction model that you need to know is the Elliott wave theory. This is a technical model that has been around for nearly a century. It was actually first to predict a bottom in the stock market in 1935. This theory tells us that we can interpret investor sentiment based on wave-like movements in the market. And this is all done by analyzing price movements historically. And you might be thinking at this point that history, especially for crypto, is a bad metric for predicting the future. And you'd be right. It's definitely not perfect, but stick with me here. Crypto is also heavily influenced by investor sentiment, which this model aims to represent. Fair warning here, the next part is going to be a little bit technical, so don't tune out. The theory talks about 2 kinds of waves: motive waves and corrective waves. Motive waves move in the direction of an ongoing trend and consist of 5 waves, while corrective waves move in the opposite direction, consisting of 3 waves. For example, while we're in a bull market, a motive wave might be found in an upward trend in price, while a corrective wave happens after the top is reached. We identify these waves by breaking them down further. Motive waves consist of 5 smaller waves. Stick with me here. The first wave is a motive wave, an upward price movement, followed by a second, smaller retrace wave, basically a decrease in price. Wave 4 is another retrace wave, a smaller negative negative price movement relative to wave 3. And finally, wave 5 brings the asset's price to its high. Corrective waves happen after wave 5 and are broken into 3 smaller waves, call them A, B, and C. Wave A in this theory is an impulse wave that takes the price down. Think of it as a correction in a bull market. While wave B is a smaller retrace wave that takes the price back up, but not all the way back up to its all-time high. Wave C is the last corrective impulse wave, supposedly signaling the bottom of the price for this cycle. This theory of reading patterns in price movements is one of the oldest technical analysis methods, and it's influenced the way people all around the world invest. But of course, it has its limitations in the context of crypto because investor sentiment has so much more of an impact on price here compared to stocks. We've seen support for Bitcoin rise and fall this year because of institutional behavior, investor confidence, and of course, Elon Musk tweeting. Either way, this model is a good one to be mindful of in the future. You'll also want to be mindful of the fact that you can get $250 in free Bitcoin when you make an interest earning account with BlockFi, linked in the description below. And then we have one of the newer models on the list, the Bitcoin Rainbow Chart. This is designed to help investors find entry points in the market, and this is very, very helpful. So under the assumption that Bitcoin will continue to rise in price over the long term, this model takes into account historical price movements specific to the asset that it's measuring. Every crypto has its own rainbow chart. There's an Ethereum rainbow chart, Doge, Shiba, you name it. The Bitcoin rainbow chart applies a logarithmic regression to historical price points to show what the possible movement of its price will be relative to time. Put simply, the chart takes the past price movements and then calculates them forward at a slower decaying rate. This is because as an asset increases in market cap, its price will inherently increase more slowly. From there, a rainbow band is applied to help investors find highs and lows relative to the current price range. If the price is in the blue or green colors, it's a signal to accumulate more Bitcoin. Yellow in the middle signals cautious hodling, while orange and red colors signal a high risk correction. This is a very useful tool for learning how to read cryptographs for entry points. Us apes, we love when things are color coded because the colors make it easy to spot when Bitcoin or any other crypto is overbought or oversold. And this offers us some insights based on real world information, though there is a drawback. Projections based on historical adoption of Bitcoin do sometimes fail to accurately predict price. When Bitcoin first hit $1,000, many investors thought it was a bad point to enter because they were looking at how the price moved previously. And you know how this story ends. Only a few years later, in 2017, the price hit $20,000, then $60,000 3 years after that, of course, defying those original expectations. But if you've decided to commit to Bitcoin and by extension crypto for the long term, you can use rainbow charts to build a long-term investing plan and get good entry points along the way. Now, last on my lineup is probably the most famous on the list, renowned for predicting Bitcoin's value very close to its actual value over time. This is the stock to flow model. This was popularized by an anonymous crypto commenter who goes by the name Plan B. With a surprisingly simple formula previously used to evaluate precious metals like gold and silver, he was able to approximate Bitcoin's intrinsic value by comparing its relative scarcity to that of those precious metals. In fact, in the 2 years that this model has been in use, there have only been a handful of price deviations caused by major news events. Other than that, it's been right on track. When the model was first introduced, Plan B predicted that after the May 2020 halving of Bitcoin's supply, Bitcoin's market cap would hit $1 trillion, resulting in a price of $55,000. Bitcoin eventually exceeded that prediction in February 2021. So how does this work? Stock to flow is a measure of relative scarcity. We get the figure for Bitcoin by dividing its current available stock of Bitcoin by the projected new supply produced this year. So take the total Bitcoin in circulation divided by the total new Bitcoin expected to be mined this year. The higher the resulting number, the more scarce the asset is, and therefore the more valuable that asset is. Take the comparison that was included in Plan B's original article. Notice here how gold is at the top of the list with an SF of 62. It also has the highest valuation compared to silver and the other metals, all with lower stock to flow numbers. Now to evaluate Bitcoin. Taking a look at the number of Bitcoins in circulation in 2019, which is about 17.5 million, and dividing that by the supply that was released that year or produced in the same year, about 700,000, this gives us an SF or stock to flow of 25. Then in 2020, Bitcoin's SF had more than doubled to 56.6, a direct result of the halving in May last year, meaning production was cut in half. Using linear regression functions, we arrive at a price prediction for the period that you're measuring. Also, just one note here, when you're doing these calculations for yourself, deduct 1 million Bitcoin from the total supply to make up for the lost coins that were first generated by Satoshi. So far, this model has been fairly spot on, but Plan B himself did point out that this model is not able to account for demand. More recently, the predicted price for Bitcoin in August 2021 would have been $115,000 if it were to purely follow the stock-to-flow prediction, but events like rumored Chinese legislation and Tesla being Tesla all affect investor confidence, demand, and Bitcoin's price volatility. One last interesting thing on stock-to-flow is it seems to only be accurate when evaluating Bitcoin's long-term price movements, and it is not useful for day trading. It also doesn't work for other cryptos like Ethereum or Litecoin because altcoins' price movements actually tend to align with Bitcoin's stock to flow over time, and this just reinforces how much of an indicator Bitcoin's performance is for the entire crypto market. Altcoins haven't been able to escape Bitcoin's gravitational pull just yet. Now, attempting to predict prices in crypto is always going to be a gamble, but luckily for us, Bitcoin has been in circulation long enough for us to see its historical performance and to use qualitative methods to approximate where it could be in the future. In my opinion, each of these models is best used in conjunction with each other. That way you have as much insight as possible before you put your cash on the table. What is evident though is that over time, the general trajectory for Bitcoin is up, while it remains a scarce commodity and while institutions continue to adopt it as a store of value. So there will always be last-minute price impacting events, but by learning to read Bitcoin's price movements, you'll be better informed to strategize and adapt in the long run. And that's going to do it. Go out there, make some money, join the Patreon if you want to invest it, and as always, have a profitable day.